Gold has broken $4,350 per ounce. Silver is trading above $78, while mainstream analysts celebrate a supposed soft landing. Peter Schiff is issuing a clear and urgent warning. QE5 is already here, not with big announcements or press conferences, but through silent, large-scale purchases of treasury bills and continued balance sheet expansion by the Federal Reserve. This is the fifth major round of quantitative easing, and according to the Austrian School, it is laying the foundation for the next major economic distortion. In the next minutes, I will explain from the Austrian perspective what QE5 really means, how it creates massive malinvestments, why it leads to the boom and bust cycle, and what this means for your wealth in the United States, Canada, and Australia. Let's dive in. Peter Schiff has been one of the most consistent critics of the Federal Reserve for over 2 decades. In early 2026, he is once again warning that we are already deep into QE5, even if the Fed refuses to call it that. The mechanism is clear. The Fed is buying large quantities of short-term Treasury securities. This creates new money out of nothing and injects it directly into the financial system. This is classic quantitative easing, just under a different name. From an Austrian viewpoint, this is not stimulus. It is monetary inflation and credit expansion at its core. And as Ludwig von Mises and Friedrich Hayek warned us over a century ago, such policies never produce sustainable prosperity. They only create artificial booms followed by painful corrections. Let us now look at this from the pure Austrian school perspective, particularly through the lens of the Austrian business cycle theory, ABCT, developed by Mises and Hayek. When the central bank expands the money supply and pushes interest rates artificially low, it distorts the most important price signal in the economy, the interest rate. Interest rates should naturally reflect people's time preference, how much they value present consumption versus future consumption. When the Fed forces rates lower than the natural market rate, businesses receive a false signal. Long-term projects suddenly appear profitable that would not be viable under normal conditions. This leads to malinvestment, widespread misallocation of capital and resources. Companies overinvest in higher-order goods, long-term projects like real estate, tech startups, factories, etc., while underinvesting in consumer goods that people actually want right now. The boom feels good in the beginning. Stock markets rise, real estate prices explode, and everyone seems to be getting richer. But this prosperity is illusory. It is built on distorted price signals and cheap credit, not on real savings or genuine consumer demand. Eventually, the reality must surface. Resources run out, costs rise, and the central bank either has to let rates normalize, triggering a bust, or print even more money, leading to higher inflation. This is exactly the cycle we have seen repeatedly. 2001, 2008, 2020, and now again in 2026. Another crucial Austrian concept that explains the damage of QE5 is the Cantillon effect. Named after the 18th century economist Richard Cantillon. When new money is created, it does not reach all parts of the economy at the same time. The banks, hedge funds, large corporations, and those closest to the central bank receive the new money first. They can buy assets, stocks, real estate, commodities, at still relatively low prices. Only later does this new money flow into the broader economy, after prices have already risen. This is why asset owners get richer during QE periods, while wage earners and savers lose purchasing power. This is the hidden redistribution mechanism of modern monetary policy. It is not neutral. It systematically transfers wealth from the middle class to the financial elite. Roland Baader called this process Geldsozialismus, or money socialism, a system where the state and connected elites use the printing press to enrich. The consequences of QE5 will not stop at the US border. What starts as monetary policy in Washington ripples through the entire Western world. In the United States, we are likely to see continued artificial asset inflation. Stocks and real estate may rise further in nominal terms, while real wages stagnate or even decline in purchasing power. The middle class will continue to feel squeezed as everyday costs, housing, food, energy, and insurance, keep climbing. This is the classic outcome of prolonged monetary expansion. The rich get richer through asset appreciation, while wage earners fall further behind. In Canada, the situation is even more precarious. The Canadian economy is heavily tied to the US dollar, and the Bank of Canada tends to follow the Fed's lead. Another round of monetary easing will likely inflate the already overheated housing market even further, creating yet another bubble built on cheap credit. At the same time, imported inflation from a weaker US dollar will push up prices for groceries, fuel, and consumer goods. Canadian savers and pensioners will quietly lose purchasing power year after year. Australia faces a similar dilemma. As a major commodity exporter, Australia may temporarily benefit from higher nominal commodity prices caused by global liquidity. However, a slowdown in the US or a new global recession would hit Australian exports hard. The Reserve Bank of Australia will once again be forced to choose between fighting inflation and supporting growth, a choice no central bank can truly win under the current system. Roland Baader described this reality with brutal clarity. He wrote, "Inflation is the most insidious form of theft ever invented. It is theft by the state from its own citizens, carried out through the silent devaluation of money." He also warned, "Monetary socialism is the perfect form of socialism because the victims do not realize they are being robbed. They even believe the state is doing them a favor." This is exactly what we are witnessing across the US, Canada, and Australia. The middle class is being slowly expropriated through inflation, while governments and financial elites finance themselves through the printing press. The Cantillon effect ensures that new money benefits those closest to the central bank first, and ordinary citizens pay the bill later through higher prices and lower real wages. The Austrian School has been warning about this mechanism for over a century. What we see in 2026 is not bad luck or external shocks. It is the logical and predictable result of decades of monetary intervention. The longer this policy continues, the more painful the eventual correction will be. Peter Schiff is warning us for a reason. QE5 is not coming. It is already active. From the Austrian School perspective, this policy is not a solution. It is the cause of the instability we keep experiencing. Malinvestment, distorted price signals, and the Cantillon effect are not side effects. They are the direct and predictable result of central bank intervention. The only real protection in such an environment remains sound money, particularly physical gold and silver. If you found this analysis valuable, please subscribe and hit the notification bell. We publish twice a week. Comment below. Do you believe we are already in QE5? Thank you for watching. Stay vigilant, stay free, and protect your wealth. See you in the next video.